Hey, Miss G here. We're gonna work on um, covering chapters 18 through 20 in this video, and I just wanted us to feel comfortable with the adjustments and then the new income statement and the new balance sheet, and then what we have is our statement of retained earnings. So I'm going to go through the lesson using the textbook, and I wanted to do that so you could have a point of reference as we go through. So like I said, we'll be covering chapters 18 through 20 in this video. 18 starts on page 516, and then it carries through to the end of chapter 20, and that is going to wrap us up in, or on, I should say, about page 598. So with all that said, I gave you some papers, and those papers looked like this, and we are going to use the example in the textbook to help us. And I'm going to go through to refresh with you. And so you should have this paper, which I would color code like I have done. I also gave you this paper on the second page, and then you should also have your income statement, retained earnings, and balance sheet. So that should give you enough time to get set up and tear them apart if you want to, so you are feeling okay with everything. So adjustments we talked about them back in Appendix A, and they are the same. They are assets that are used up that are not updated at the end of the year, and we need to update them. I understand that the quality of this is not all that great. I had to make do with the copy machine, so my apologies with all of that. So just so you know, this came from the textbook, and it is on page 532 if you would like a better copy. All right, so at the beginning of chapter 18, we are looking at adjusting, and we still have the same here. We have the who, the what, and the when. And we have all the accounts listed. They're just longer this time. And we have the trial balance section, the adjustment section, the adjusted trial balance section, the income statement section, and the balance sheet section. So all of that is still the same. I still like to refer to the trial balance as the beginning, meaning the numbers that essentially come off the ledger. The adjustments are the middle, and that's what we are updating. And then the adjusted trial balance is going to be the difference between the trial balance and the adjustments. And then we move over to the income statement and the balance sheet. So the moving over part is still the same on here. Your assets, your liabilities, and your owner's equity all go on the balance sheet, and your revenue and your expenses, including income summary, goes on the income statement. And I've drawn a line between lines 19 and 20 to show you the difference between the two. Remember when we did this before, we put an X here, so it would keep you from taking the numbers here and putting them in the income statement, because we want them to go from here to here. And then you could also put an X here. Remember, all these are our temporary, all these are our temporary accounts, and all these are our permanent accounts. So one of the adjustments we have to make in this chapter is to merchandise inventory. And merchandise inventory is one of our new accounts, and merchandise inventory falls under our assets. So it's the merchandise that we buy, and then we turn around and we sell it, and that becomes our cost of merchandise. So what we have here, and you'll want to look at this paper, we have our merchandise inventory account. It's an asset, and it normally increases as a debit, so it decreases as a credit. It gets closed out to income summary. That's what that says, income summary. I know some of my hand notes sometimes are awful. And remember, income summary, it has a debit and it has a credit, but it does not have a normal balance. So credit means, really means a few things in this chapter. Because merchandise inventory is so interesting that it depends if we have more ending inventory than we have beginning, what happens here. So what we see is beginning inventory, okay, and that is coming off of line 3 in our worksheet. And we have our ending inventory. We physically would go around and count that, okay? So AKA physically count, just like before when we were talking about the stuff in Appendix A. So we would take the difference between our beginning inventory and our ending inventory, and that would be the amount of inventory that has decreased because it's gone, okay? So when we are taking our merchandise inventory, sorry for the bell, we are going to be decreasing it for that amount to close it out. Remember, we're closing out when we do adjusting entries, we are closing them out. So it decreases, okay? It's gone, so it gets decreased. So that means if this is a credit, income summary as a debit means your merchandise inventory is closed out to it, okay? So hopefully that is not too terribly bad. On page 522, we have an example of what happens when, and I can show you here, we have an example of what happens when it's the other way around, meaning we started the year with inventory of, let's see where the example is on this page. We started the year with inventory that is lower than the beginning, or our ending is lower than the beginning, and we would excuse me, our ending is higher than the beginning. The example I just gave you, my apologies, is the ending is lower than the beginning, clearly by those numbers there. So we, have all this inventory at the beginning of the year, and at the end of the year we have this, so this is what is gone. Sometimes what we have happen is that our merchandise inventory is, here's the example, my apologies, is that our ending is higher than the beginning. So it's not really gone. We have extras on the book. So the merchandise inventory has to go up. Remember, it's an asset. And then income summary has to be the credit because we close merchandise inventory out to income summary. And that means if this is increasing, this has to be the credit. So this one's probably the trickiest of the 4 adjusting entries that we've talked about now at this point, because it can do 2 different things. So just remember, if we end up with a higher ending number, that it has to be increasing because we have more on the books, and then we're going to increase that value to show so. And then this has to be the credit. So with all that said, the next one is supplies, and we've done this before. We have our beginning inventory, and then we have our on hand that we physically go and count what's left at the end of the year. So the difference between those two would be what is used. Now, supplies increase. They're an asset, okay? So they increase as a debit. So if we are adjusting and they have been used up, they are gone, it would be a decrease and it was a credit. And what happens to supplies? What does it get adjusted to? It gets adjusted to supplies expense. So, and my mistake here, I think I used the word closed out. This is for adjusting. So we're not closing this one out, we're just adjusting it to income summary. And that is totally new, because normally the only time we've used income summary at this point is when we have closed something out. So merchandise inventory gets adjusted to income summary. Now, supplies get adjusted to expense because we didn't sell them to our customers, so they become an expense of the business as we use them up. Okay, so the question will be in a second is, where do each one of these numbers go on the worksheet? All right, prepaid expense we've talked about, so let's review that. We have our prepaid insurance. we have the beginning balance of the insurance policy, how much we have used, and the difference is the ending value, what we have left for the next year. So this was the one that required us to do some math. So if we bought it December 17th, okay, and it's a 6-month policy, we've used a half a month of it. So we take the policy and we are going to, which was $1,500, and we divide that by 6 because it is a 6-month policy. That is a number 6 here if you can't read it on your paper. So per month, the policy costs us $250. And we bought it December 17th. And if you notice, we are ending our year. So we are using it for 2 months. So if I take that, we're using it for half a month, and if I take that 250 and if I divide by 2, a half of 250 is 125. So I've only used $125 worth of that policy. So with that said, the prepaid insurance is an asset. So if I've used it up, the asset is going down as a credit, and the expense is going up as a debit. All right, the other new one that we have is federal corporate income taxes. So, like most people, we try to guesstimate what our income taxes are going to be for the business. So we have at the beginning of the year tax estimate, and this is $98.40, and what we were supposed to pay was $9,925. So what this one does, this was tricky like the merchandise inventory, because it could be either way, is we have $155 that we have to still pay. So we thought we were going to pay this based on our best estimate of how much we thought we were going to bring in. We actually had to pay this, so we owe them some money. The flip side can happen too, is we think we could have this and we can end up actually being lower than that, and they owe us some money. So this can be twofold, just like this one can be twofold. So we are looking at, and this is on page 527, the federal corporate income tax expense, because it becomes an expense. In this case, because we owe more money, that has to go up, okay, as a debit, that 155. And the federal corporate income tax payable, that also has to go up because I owe them more money. So you see the payable go up. So on page 527, they show you that. And then, of course, we could have the flip side where we end up having to get paid more money back, and that would be great because it would be the opposite of this. So on page 521, we talk about merchandise inventory. On page 524, we talk about supplies. And on page 525, we talk about prepaid insurance. And then 527 talks about federal corporate income tax payable. Now, all this is important because I'm going to give you some different scenarios in this video, in this Edpuzzle, in this lesson, and you're going to have to be able to answer them. So that's the work for that on that page. Now, with all that said, if you have a couple highlighters, may I suggest that you take them out, and we'll kind of connect where these go. Line 3 is for merchandise inventory. Okay, that's an asset, so you'll find it up with the assets. And then remember, we are adjusting to income summary. This is totally new, and that's on line 20, so we'll highlight that. So we see our merchandise, our beginning amount of inventory that we have, and then of course we physically would go around and we would count, so that's our ending, and we would solve for the middle. So if we, and remember we have the little letters here, so if this is how much we've used, that would be a decrease, and that gets transferred over to balance sheet here. And then, of course, you have to have 2 little A's. So you have to have 2 matches. Okay, and we do down here. And I know this is really, really hard to see on that dark copy. Income summary should have 2 lines here because we haven't used it before. And if this is a credit, this has to be a debit. And there's no balance before. So the 3536 gets slid over here. And then, of course, this one falls on the income statement. It's underneath that line that we drew. It's a temporary account. So it is over here. Okay, so this can be flipped. Remember, merchandise inventory. If this ending inventory is higher, meaning we made a lot of purchases and we didn't sell a lot essentially, and then our beginning, this becomes the debit and this becomes the credit. All right, the second color that we want to have handy is for supplies, and supplies are line 4. This one's the easier one. And then supplies expenses, line 37. Okay, so with all that said, supplies are an asset. We go around and count, see how much we have left, and this is the amount that's used. Both of these, in this case, are decreases. So they become expenses. There's probably not a balance before. That's why there's a line here. This one is going to increase. It's an expense, so it increases as a debit. And then we carry it over to the income statement because that's where it goes. And of course, we take the difference and we go here to adjusted trial balance, and then we carry it over to one of the two statements that it belongs on, because then we'll pull this off to do our financial statements. All right, third color I need is for our prepaid insurance, which is on line 5. So I'm going to highlight that here. And then it's pair, because we're on our third one, so you're going to see the letter C. That is going to be on line 31, right here. All right, so remember prepaid insurance, we bought the policy. The policy was a 6-month policy, so we divided by 6. We got $250. And we used it for a quarter of a month. And this should say 125 if you can't really see it. Or we used it for half a month, excuse me. So 250 divided in half is 125. And this is the amount that we've used up. So it is decreasing as well. And that's the difference. And then it's an asset, so it gets carried over there. And then down here, it's an expense, so our expense is increasing, so it is a debit. No previous balance before. It gets carried here, and it's a temporary account, so it'll get moved over there in the end. And then our last one, and I don't know if I have another highlighter. I've got, all right, so I'm just going to do orange for federal. Federal is right here, line 10, and I don't want to marker over it. And then your federal is also, and it's going to be slightly goofy because it goes with two things. We're going to see federal here on line 30 to show that the discrepancy with how much we have still yet to pay. So we see federal income tax payable increasing. There's no balance here because we didn't know until now that we had to increase it. So there really should be 2 lines here. And then this is increasing because we owe money. We didn't pay enough, and it would be the opposite if we had paid too much. And then we carry it over. And then federal income tax expense. We had a previous because we predicted this amount. And so our expense is going to be going up because we have to add to it because we owe them more money. Total it together, adjustment, and it's temporary, so it goes on the income statement, and it is carried over here. And of course, just like before, we would add these 2 columns up. These 2 numbers should match, double underline. Add these 2 columns up. These 2 numbers should match, double underline. Add these 2 columns up, double underline. And then here, remember, is how you figure out if you have a net income or a net loss. And I like to remember it that with income statement, that when I add these 2 up, these 2 numbers will not match. But if this is higher, my credit is higher, that means my revenues are higher, I have a net income. Number goes here. Then you add down, bring down, and they should match. And then if this is the debit, this has to be the credit, because remember, net income increases our, in this case, our equity, and we increase equity with a credit, so it has to go here. And then this one has to be a debit, and this one has to be a credit, and then add and then bring down, and these 2 numbers should match. If we had a net loss, it'd be on the inside, okay, because it would bring down my capital. And how do I bring down my capital? With a debit. Okay, so that is that. And you can, of course, go back and rewatch if I'm talking 90 miles a minute. And I want to go over the income statement with you. And this information starts on page technically it starts on page 557, but they give you a little background on ownership in a corporation. But between my class and Miss Ballard's class, you should know that a corporation is owned by stockholders and you have stock. So on our income statement, which is a lot different than the other one, but the idea is still the same. We still have who, what, and when. And if it's for the year, it'll say for the year ended, for the quarter ended, for the period, depending on when you're doing it for. Okay, so we still have the revenue section, but because we have these contra accounts, it gets a little more wide. Okay, so revenue. We have our sales number. It's coming from line 21 on the worksheet. Okay, so you're getting all your numbers from the worksheet. That number is almost a grand total. So we have like a bunch of subtotal columns, and it should make sense as we go through. So that goes in the second to last column. You don't have to know this for the final exam, and this is really the introduction to what would be accounting 2. So it's okay as long as you get the theory. All right, so now tying in chapters 14 through 17. When we have sales, we offer discounts to our customers, and customers return things. So we have to take in that because it's going to bring down our sales. So we do less sales discounts, sales returns, and allowances. So we put that off of line 22 on the worksheet and line 23 on the worksheet, and we draw a line and we add them together. This will now get us our true net sales. So when we take the discount and the returns and allowances, that number goes right here. Okay, and then we take these two and we're going to subtract, and this gets us our true net sales. All right, so now we have a new section. It's called cost of merchandise, because we have this merchandise that we buy, and it's great if we have amazing sales, but we have bought way too much merchandise, and that's going to affect our sales because we have all this inventory essentially sitting around. So we have a section called cost of merchandise, and you have merchandise inventory at the beginning of the year, and this is going to come from the trial balance number, because that represents the beginning. So we are right here with this number here, and it's the second to last number. We have all our purchases, meaning all the merchandise that we bought throughout the year. This is going to go way over here because you're going to see it's going to bring over. And then if we have to pay for the merchandise to get there, transportation in, that it gets added to the purchases, because of course we have to build in that cost to our business, and you're going to see that here. So we're going to add that to it, and then that's our cost of our delivered merchandise. So what we purchased and how much it costs to get to us is this number here. Then, of course, we might get discounts, which is great because that will essentially allow us to either give the customer more of a discount if we get discounts, or if we have returns, we don't want to account for that, meaning on our merchandise because we don't have it anymore. But if we do get discounts, we can either pass that along to the customer, or we cannot, and then just make more of a profit if we want to. So we take our discounts, which is coming from line 26 on the worksheet and 27 for the returns. We'll add those together, and that will get us our number here. So then we'll take these two, we'll take our cost of our merchandise and the stuff that, the discounts that we got that aren't really a cost of the merchandise, and the things we don't have anymore that we returned. And that will get us our net purchases. We take our net purchases and the merchandise inventory, we're going to add them together because this is the inventory we had before, and we're going to add that to all the inventory that we bought throughout the year minus the discounts and minus the returns, and now we have our cost of merchandise available. But that's not the true number either, okay, because we have sold merchandise. So we need our merchandise inventory at the end of the year, which is on line 3, same line. So this is the beginning of the year, and this is the end of the year where we physically went around and counted, and that number goes here. I'm going to subtract, and that will get me my cost of merchandise sold. So each category essentially ends up going in the right-hand column, excuse me. So revenue is here, and then cost of merchandise is here. So now I've taken my revenue, and all of the merchandise I still have sitting around is going to bring down that revenue. So I'm going to take those two numbers and I'm going to subtract. And now I have my gross profit on sales. And we've heard that word gross before. That means I have to now, of course, take out my expenses, which we've done before. So we would go get all our expenses, and they get listed in this column here. We'll total them up, and we'll put the total expenses here. Then, of course, we subtract because it brings down our revenue, or our gross sales in this case. And when I subtract them, I either have a net income or I have a net loss. And this also indicates to us if we paid accurately to the federal government. So this is what we call operating income. And then we've gone and figured out how much we should have paid in those adjusting entries to the government in taxes, if you remember just from a few minutes ago in the video. And when we have supposed to have paid, I'm sorry, I'm down here on line 30. I was supposed to pay this amount here. When I paid this, this is the number that needs to get represented. And I would subtract that out. And now I finally have my net income. Now, of course, if it's flipped in any way, shape, or form, I would have a net loss. This number is important. We're going to carry it on, okay, to our slightly new statement. So we have who, what, and when, but this is the statement of retained earnings this time because we're a corporation, okay? So when they ask you questions about the heading, it's all centered, all that's the same. This one's just statement of retained earnings. Actually, a lot easier than the one from chapters 1 through 10. So we have our retained earnings, okay, the earnings that we have retained, and this would be essentially from the year before. That comes from line 19 of the worksheet. And we have our retained earnings. And since we need this number right here, that's why you have to do the income statement first, then you do the statement of retained earnings, and then you do the balance sheet, because each one needs the number, and that's why you have to do it in this particular order when you're talking about the financial statements. Remember, the worksheet you don't technically have to do. It's not a financial statement. So in this example, I have a net income. So I would take my retained earnings, the earnings that I've retained from last year. Some businesses give it back to the customer, some just keep it and reuse it and add more value into the business. It's really a corporation's call slash their board's call. So we have a net income, so we take those two and we add, and that's our retained earnings at the end of December. So here's a new account. Make sure you have this in your notes. It's called retained earnings. That's what RE stands for. It increases as a credit, okay, and it's going to increase by net income, and it's going to decrease if it's a net loss. So my retained earnings would essentially, and I can point you in a direction that might make a little bit more sense. Retained earnings is on page 565, and our retained earnings are going to get carried over right here to this line on our balance sheet. Okay, so we need the bottom number on the income statement to put here on the second line, and then we need this number over here on the balance sheet, the last line on the retained earnings. Okay, so last one. Who, what, and when on the balance sheets. All that's the same. Remember, this one does not have a beginning, middle, and end, so you do not do for the year ended, because these are just the value of these items, or the debt we owe, or our equity at that moment in time, which happens to be December 31st. Okay, so we write the word asset center, list all our assets, put them in the left-hand column, total them up, total assets. Write the word liabilities, list all our liabilities, okay, all coming off the worksheet, total them up, put the amount here. Remember, it's assets equal liabilities. Instead of owner's equity now, it's stockholders' equity. We write the word stockholders' equity here. We have capital stock, that's part of equity. That comes from line 18. We have retained earnings, which comes from your income, your statement of retained earnings right here. And if it is essentially a net income or an increase, you add. If it is not, you would subtract, because it would bring it down. Okay, it means you're having a bad year. So we add the capital stock to the retained earnings, and we get our total stockholders' equity over here. Then, of course, we take the liabilities and the stockholders' equity and add them together, and that gets us our total liabilities. These two numbers have to match. If they do, you double underline. Everything gets double underlined, and we are all done. All right, I hope that helps. Please feel free to rewatch any of this so you are okay to answer the questions at the end of each of the sections in the Ed Puzzle. Thank you.